Every day there's news, and sometimes this has a good reaction to stocks and sometimes it has a bad reaction to stocks. What we want to do is capture the good reaction to stocks. When price goes parabolic because of good news, we're going to sell at the top. Seems pretty easy, right? But we're going to go into a lot of videos of why and why not to do some things in this course. Now for the challenge. This is about you. It's about you comprehending and being able to experience these trades for yourself. My challenge is that you won't only watch these videos, but you'll also watch other videos on the subject matter so you can get a broader scope of every subject that we talk about, which this is the first step of comprehending something, gathering all the information in so that you can correctly divide what you think, what you see, and how you react. Once you watch all these videos and you feel comfortable with the understanding, you'll be able to put that knowledge to the test and experience the things now that you understand. Just know this, like in life, there's always a learning curve, and forever you will be learning. And 10 years from now, you'll learn something, you'll say, man, I'm so glad I learned that. From here, you'll only get better and better. Now on to the course. And the picture of sell the news is kind of a pump and dump. Huge parabolic run up and then a parabolic sell off right back to the old lows. But have you ever asked yourself the question, why did it stop there? If it was such good news, why didn't it just keep on going? And this is the reason why. Range box and trend lines. Off of these highs and these lows, you could create range boxes duplicated up. And once price came to the top of that range, it then sold off. The other reason is trend lines. We see this long-term resistance, then price sold off, moving away from that resistance level. But with the news, it comes right back up into that resistance level and sold off again. So in this course, we want to talk about the three types of resistance trading. One type of resistance is diagonal channel up. Another type is diagonal channel down. And the last one is horizontal channel sideways. And here's a visual of the three different types. So on this bullish channel up, like our other diagram, you see there are levels of resistance. In a downtrend bearish channel, you can see that there are counter trend moves up, which act as resistance, and then price falls lower with the trend. Same with horizontal channel, price moves higher, comes into the resistance area, sell the news, and price falls off. And did you know that there's math behind these channels? Probably, but let me define it a little bit better for you. Simple moving average. Simple moving average is calculated by adding the price of the stock over a number of time periods, then dividing the sum by the number of time periods. Basically, it's an average of price given over a time, which on a chart looks something like this, with the blue line being the average of price. As price moves away from the blue line, it comes back to the blue line, letting you know that price is average. Comes away from the blue line, telling you that price is not at average, then goes back to the blue line saying price is at average. Now let's use the same exact theory and go a little bit deeper. Bollinger Bands work simultaneously with the standard deviation of the moving average. No, I'm not going to teach the math behind the standard deviation. I'm going to give you the cliff notes. Imagine this 0 point is the moving average, where price always comes back to. If price goes out 34% from the 0 point, standard deviation says it will come back to that point, which that's why moving average works as an indicator. If the price moves up or if it moves down, it uses this center point as a home base. The further it gets away from home base, there's very little probability that it will stay there. Most likely, the higher probability is it will go back to home base. So when price gets out to a 2 standard deviation, plus or minus, it lets us know there's very little possibility of probability through math that this will stay outside of that range. And you can figure this either by doing a curved line, Bollinger Bands, moving average, Keltner bands, or with a different mathematical equation, you can use the standard deviation or linear regression lines. Here's the math on linear regression lines. As price moves up, there's a high probability that it's going to come back to that center line, giving us resistance on the outside of the channel. I don't like using Bollinger Bands because it's so sloppy, as you can see, but the middle line being the center point is the moving average. When price moves out from that moving average, in our case, sell the news, there's a high probability that it will come back to that center point. And here's what Thinkorswim has to say about this. The standard deviation channel, the statistical results on a 1 standard deviation is 67% of the time, it will stay in between that channel, upper and lower. 67% is pretty good, but if you raise the standard deviation to a 2, like we showed in the first example, that means price should fall between those two lines 95% of the time. That is a huge probability. It is likely to move back from those resistance lines unless a major trend reversal is taking place. So here's the chart. And remember, we're selling the news. So price shoots up, comes into our resistance line of the standard deviation, and has a 95% chance that it's going to move back lower based on the math. I know that was a lot, but let me show you a couple reasonings behind it. Okay, here's eBay, 180 days, 1 hour. We're using the standard deviation, number 1. So you can see by the red and green circles that price moved outside of that one standard deviation 5 different times. Now, it did move back to that center line, but sometimes making reversal patterns, being outside of that one standard deviation by a whole month before going in the right direction. So 5 times it went outside of the one standard deviation. Then you can see by the blue arrows that 7 times it stayed within the one standard deviation. And that lines up pretty much with what they said. 67% of the time it will fall in between the upper and lower on a 1% deviation. Now let's test a 2% deviation and see if it falls within 95% of the time, those 2 points. So now I'm going to change it to 2 and let's see the results. Same time frame, and we see that price has stayed in between those 2 lines. What is this? It's a channel. What is it? It's resistance. This is the math behind channels. Right here, you see this big spike candle, sell the news. Then what does price do? Comes back down to this midpoint, giving you huge profits. So back to the channels. When we see a huge move up into resistance, the math tells us that we should get a sell-off, at least back to the midpoint. Another thing that gives us high probability is the structure of a channel. And within the structure of a channel, we have an Elliott wave pattern and an ABC pattern. An Elliott wave has 5 legs. It'll have 3 impulse legs, making higher highs, which will create the resistance side of the channel. Then it will have 2 corrective pullbacks, counter trend trade, which is an ABCD pattern, making higher lows, and that creates the support side of the channel. The 3 impulse waves up, wave 1, wave 3, wave 5, giving us our overall trend. At the high points of these waves, you'll see higher highs. Leg 3, higher high, and leg 5 is higher than leg 3, giving us the uptrend. Based on those highs, will give us the resistance. As news comes up into that resistance, we'll know where to take the trade. There are pullbacks after an impulse wave. This is called an ABCD pattern, and you can see it's counter trend, wave 2 and wave 4. Once they complete their bottom before continuing into an impulse wave, this will be the support line of the channel. After the completion of an Elliott wave, there'll be an A, B, C pattern. The A leg is an impulse wave. The B leg is a counter trend of the impulse wave. And then the C leg will be the same direction as the A leg and typically the same size. So yes, you should have an ABCD pattern in leg 2 and leg 4. These are the only 2 patterns that you should be identifying with when trading. Am I in an Elliott wave? And if I am in an Elliott wave, where am I? And am I leg 2, leg 3, leg 5? Because you would handle each trade differently. Obviously, if you're coming into resistance on a leg 5, that'd be a great indication that you should have a long A leg away from that resistance. And this is what I mean by there'll be an Elliott wave inside an Elliott wave inside an ABCD pattern. In this big leg, you'll see small impulse and pullbacks as this leg goes up. Just as this leg goes down, you'll see price move down, then go back up a little bit before continuing lower. And also depending on what time frame, 1 day, 1 hour, 1 minute, you'll see the Elliott wave show up differently. One of the most important things about the Elliott wave is making higher highs with higher lows indicates an uptrend. When price breaks those lows and starts making lower lows and lower highs, that indicates a downtrend. Now there's 3 types of Elliott wave impulse legs. Leg 1 could be the longest, leg 3 could be the longest, or leg 5 could be the longest. Let me show you. Like this one on leg 1 is really big compared to leg 3 and leg 5. On this one, you see the middle leg being the biggest of the impulse waves, and leg 1 and leg 5 are shorter. On this instance, you see that leg 5 is the longest over leg 1 and leg 3. Why is this important? Because you might see a price jump up, but if resistance is higher, you don't want to buy that trade there. You want to wait for price to continue on into that upper resistance area. Same with this. Price might seem very close to that upper resistance level, but we need to be patient to watch. SFL came up in our gainers with a nice big move of 7%. But we can see even though it's rallied up, it hasn't come all the way to the resistance. So we can't take that trade. DBI also on the alerts has a really big leg 3 with a small leg 1 and leg 5. We can't take this one because price is over here and we need it to be up against resistance. Now a little bit deeper into ABC patterns. You have 2 impulse Elliott waves with 1 smaller ABC corrective pattern inside this pattern. Now why is that important? Because when you have an impulse wave up into that resistance, making an upper channel, we are going to be placing the trade here. Then price is going to make an ABCD pattern lower, giving us our profits. But sometimes in upper reversal channel patterns, you'll see an ABCD pattern back up, almost coming equal to where we entered to the trade, erasing away all of the profits we made before going back into the right direction, getting us out of the trade. Here's another reversal pattern that we see all of the time. This would probably be considered leg 3. Then you would have ABCD pattern, leg 4 into leg 5. Let's focus on if we entered the trade right here, what does it look like? Kind of looks like this pattern here, right? Where price came up heavy, sold off a little bit, rallied a little bit more, then came back down for a head and shoulders pattern and lower lows, giving us our profit. But that's why I don't exit the trade, because if I enter here and price goes against me, I can identify with this pattern because I understand Elliott wave and ABCD patterns and know over time I have a high probability of this thing working out. We have a choice at that moment of time of doubling down, but we cannot exit the trade. We have to be committed. Another reason I'm going through all of these things is because I need you to understand the time that these patterns take. If we enter into the trade here, let's say it takes 3 days for this to go down, 4 days for it to go back up, 3 days for it to go down, 2 days back up, before it goes right in our direction, making up almost 20 plus days. So we need to make sure that we have enough time on our options for all these patterns to work out. Here we have a bearish wedge. What if we got in right here on a huge impulse wave up? Then price flutters against us. We would be losing money at this time, but we need to be patient enough for this wedge pattern to work out, to go lower so that we can take our profits and make sure our options are long enough for this whole month or more. Again, impulse wave up. We get into the trade right here. Price makes an expansion pattern before going into our direction. I don't mind this because time decay. And I'll get into that when we talk about options. But we need to understand the behavior of these corrective patterns and reversal patterns so that we can be ready to identify them and prepared. Now realize this, when you're looking at patterns, there's big ones and there's small ones. On CAR, we have 3 points of resistance, but each time it came into resistance, it did something different. Remember when we talked about the impulse wave, there's leg 1, there's leg 3, then look how much longer the last leg, number 5 was. Next time you have a short leg 1 and leg 5 with a huge 3 leg. Right here, it touched once and reversed. Over here, it gave you a double top. See how long price went sideways before really going in your direction. At this point, it was making a broadening pattern. At the same time, it made a head and shoulders pattern. Huge sell-off. Wait for the next segment where we talk about this range box duplication. Potentially, it could even have a bigger head and shoulders pattern forming right now. We are up against resistance. Old support makes new resistance. Big first leg, then smaller legs of the Elliott wave up into resistance. Making a broadening pattern just broke down. Pepsi coming into resistance, making a broadening pattern. Then next time, it starts making a wedge formation. Leg 1, relatively small. The big leg 3 impulse wave, and then consolidation. Imagine if we would have got in right here. This is a tough trade because it's 41 days straight sideways. But since we had small profit target, we got out here. So the more things you can identify up against that resistance line will be helpful for you to understand the timing that potentially this trade could take. And I know it's hard because you only see one candle hitting against that. And then you're like, should I take this trade or not? And that's why we put other things into our rules to help apply safety to your trades. And that's why you're going to want to study these reversal patterns. Another pattern that's just a more glorified head and shoulders that we see all the time is a harmonic pattern. Harmonic patterns have impulse waves and then basically ABCD patterns. The only difference between each one of them is Fibonacci levels. And before we get started, I just want to bring you back to your mind's eye of this right here, where you have these three reversal patterns and the highest point has a previous lower high. Big impulse wave up into that high, and then it went higher high, and then it went down. You can see the Elliott wave completion pattern here. It's the same thing with harmonic patterns. Like this bear's crab pattern, the number 3 leg wave is the impulse up into this X, making resistance. Then price consolidates a little bit before going up into the head, then retracing lower. Same thing with the butterfly pattern. Price comes up into the X, then consolidates leg 4, going into the head pattern, which is the D, then reversing much, much lower. Can you see why I call it a glorified head and shoulders pattern? It's all saying the exact same thing. And here's the main difference you need to know about patterns is the Gartley pattern has a completion that would more so look like the outside shoulder. Coming into the X leg would be the head, then the fall off with the leg 2 consolidation into the D getting ready to fall back off. Same thing with the bat. It just has a higher Fibonacci retracement at 0.88, which is pretty close to a double top. As we mentioned, butterfly pattern before, it has a Fibonacci range between a 1.27 and a 1.61, still creating the reversal pattern at the D, which is the head. Crab pattern and deep crab are basically a 1.61 all the way up to a 361. Price comes up, consolidates, goes up into the head, then sells off. Like this one here, you can see a big impulse wave up into resistance, then the consolidation, continuation into that resistance, making a very big head and shoulders pattern. Then it fell off. Now it's completing the head and shoulders pattern. Here you can see this pattern made a W up into old resistance and diagonal resistance, then fell off. You don't have to buy any special software or use these harmonic patterns. I just wanted to show you what it looks like to what potentially you could see with the Elliott wave, especially with head and shoulder patterns and other things that will present itself when you come into resistance. The more you know, the better trader you are. It's not only important to know how to identify that pattern and how it will feel while trading that pattern, but what will happen after that pattern. What is the result that typically happens after that pattern takes place? So with a bearish double top, we see that we make a range box and then price would go down, duplicating that range box, giving us a lower target here, which is great if we bought here up against resistance. That's a big move down, giving us a lot of profit. Same thing here. If we got into the trade, head and shoulders usually creates a range box, and then you duplicate that range box down, and price typically goes down to that lower support level, giving you a very big move off of these highs over here. Bearish wedge, same thing, range box, duplicate the range box down, giving you much lower lows. Expanding triangles, do the exact same thing. So as price breaks lower, when you enter the trade back here, it'll make a nice profit for you. Also with the triple top, range box duplication, voila, huge profits. But you had to wait a long time, which we saw that range box duplication in this ABCD pattern. Let me reconfirm what we just showed you looking at range boxes for targets on those patterns. On a horizontal channel, when it comes up into this resistance, it sells off. When it comes into the support, it bounces back up. At some point, it will come out of that channel. And a lot of times, this range-bound motion will happen again. And that's why we use range boxes. Or you can take your channel, make a duplication, and bring that up, setting the one on top of the other, giving you a new resistance area. Now, believe it or not, diagonal channels can be used the same way. Price flutters back and forth, hitting support and resistance. Then it breaks out. Where's it going to go? That's right. Just duplicate this channel right here, bring it down on top of this old line, and it will give you a new support area. In some cases, you can do this multiple times. Same with a bearish channel breakout. Duplicate that channel up, and it will show you where new resistance will be. Like on Hertz, up almost 7% today. Duplicate that range box up, and you can see prices coming into that resistance. If we draw a diagonal line, we see prices also coming into that resistance. Great place to take a trade as price falls off. So range box can be used to identify when price is running up and gonna hit resistance, and when you're shorting it, it can be identified for support. Your near-term support level would be down here. Your long-term support level would be way down here. But I don't want to be in the trade for that long. I'm going to show you how to maximize your profits in a very quick time. And so really, what is this? It's just creating a channel based off support and resistance and duplicating it down, which should make sense because we said once price breaks lower than the old support, and what do we have right here? Price went lower, and we see that we start having lower highs, which we have right here, should confirm a downtrend. Another way to identify support and resistance is by using a channel off the higher highs, higher lows, diagonally, same way as horizontal, and duplicating that down also. This could act as a support level. IHT is up 22% today. Take from the lows and the highs, create a range box, duplicate that range box up. Seeing where resistance is, we have 4 candlesticks that went a little bit above it, but you can see the body of the candlestick has come back down underneath that resistance area. Good place to take a short. I heard you guys when you thought I was crazy by using this diagonal channel as support and resistance to identify where price would go. But if we just take from these highs and lows and we duplicate it up, we see it confirms the range box and where price went, giving us 2 confirmations this would be a great place to take a trade. MOXC, you can see support and resistance, range box. Duplicate that range box up, and you can see that MOXC is gone 17% today. Duplicate that range box up again, and where did price go to? Showing us resistance on a range box, telling us we could enter into that trade, sell the news, and take our profits lower. If we're looking for a little confirmation, we can take these highs and lows, duplicate this channel up, the wick went higher, but you can see the price coming down. Now, through most of this series, we've been talking about price coming into this upper resistance and selling it. But channels go 2 directions. So I want to talk about what it would look like to find a trade in a downtrend channel. Something like this. Price comes up, creating the top side of the channel. We probably entered a trade there and made a lot of money on the way down. It hit support, then started to rally up again, giving us a nice impulse wave into this resistance area. So we want to be able to identify this so that we can take the trade lower. Unlike MOXC, where we're taking a trade against an uptrend, we'll take a look at RELI. Went up 55% today. Where did it stop? Against resistance. These 2 candlesticks acted as resistance and has already pushed price down over 20%. This would have been a great trade. So now that we have all of this information wallowing around in your head, I'm going to show you the trades I put on in the last month, and then I'm going to show you the trades I've just put in the last couple days to get you more familiar with the picture of what we're expecting to see. It's always at resistance that we're placing the trade. On UTL, you see we had a big jump up. We took our support line, duplicated it up, used this old cluster back here, and saw the resistance. So we got into the trade right here. Price kept going higher 6 days, almost 6%. Then after 8 days, it went down 6% from where we bought it in. Our target was not realized, but just yesterday, because of time decay, we were able to take 50% profit off of this trade. Under Armour had a big spike up. We just took this channel based off the highs and lows, duplicated it up, and saw it was up against resistance. Took the trade, and immediately it went down. Seagate, we saw price way up here. We duplicated it once, saw it acted as resistance before, duplicated it up again, felt this was a good place for resistance. It went a little bit against us and then fell off nicely. Sally Beauty saw this big run up, duplicated the range box, came right into that resistance level. So we took the trade, made 50% profit in just a couple days. Saw that OCGN came up into this resistance, then sold off. We got in about here. Then it ran up 43% in 10 days. Ouch. What'd we do? We doubled down, stayed in the trade, and you can see both trades worked out. O spiked up into this resistance level and quickly sold off. 8% in 15 days, giving us our 50% profit margin on the trade. Nike had a triple top, started making lower highs and also making lower lows, meaning it's in a downtrend. We drew a diagonal line off of these candlestick bottoms, used this old high as resistance, and within a couple days, we were able to capture our profit. MVIS, you see we have a big up run, started making lower highs and lower lows, downtrend. We used this support level, duplicated it up, entered into the trade right here. It went totally against us, 4 days, 56%. Holy moly. What do you think we did? We found resistance. We were able to double down right here. Price quickly went in our direction and both trades worked out. We got into muds right here. Why? Range box duplication. We saw the candlestick come up, hit resistance, and start to fall off. The trade went against us. 7 days, 11%. We doubled down, and both trades worked. MDT, resistance, resistance, resistance. Got in the trade. 10 days later, it was against us 3%. We did not add to this one, but as you can see, after 20 days, it went down 4%, getting us out of our 50% profit target. This was a fun one because this is all I saw. These 3 candles. I saw price come up into that resistance. So I took the trade and it quickly went down. No problem. Win, win, win. Where'd it go down to? Range box duplication. Perfect. LAZR making lower highs and lower lows. Came off the support level, duplicated it up, used this as resistance, entered into the trade right here, and immediately it went in our favor. KKR, support and resistance. We got into the trade right here and it went against us. 7% in 17 days. We doubled down. The second trade is work. We're still waiting on the first trade. IBM, support, resistance. Resistance right here on this big wick. Came down, back up. back down, looking kind of like a head and shoulders pattern. As you can see, we're still waiting for this one to play out. G, big day up into that resistance level. Next couple days, we were able to get our profit. EW, big rally up into this horizontal resistance. Price kept going higher, drew a diagonal resistance line, entered into the trade right here. You can see both worked out. EHC, you can see came into resistance, quickly sold off, got us a profit. Might be a good place to re-enter into a trade and take it again. DMTK, you can see ran 35%, came into the resistance, gave us our 50% profit. BNTX came right into that resistance level, kept going higher. What do you think we did? That's right, duplicate. Price came right to our original entry. We closed this trade out and this one worked. Believe it or not, we timed this perfectly. It went up 11%. Sold off, a couple days, made our profit. Still in this trade, saw resistance. So we sold here. I was being greedy right in here. So now we wait. Airgen saw this support level, duplicated it up, used it off this resistance, saw price come right into this resistance here. Price had moved up 15%, then sold off, giving us our profit. Same look on ACET, came into resistance, within a couple days gave us our profit. So those are trades we've mostly closed out. So there were a couple scenarios in there. Some trades worked out really quickly. Some trades we had to double down on. Some trades we had to wait a long time on, and some trades we lost on. Are you starting to catch on to the theme? When you have a huge run up into resistance, people take profits, and you can capture the opposite side of this trade. Out of all those trades, we only had one loss with 50% return on our investment. That money adds up quickly. Here's some new trades. WCC up against resistance. In 4 days, it moved 18%. We placed a trade here, waiting for it to sell off. Did you see this earnings rally on UPS? The stock jumped over 25% in 7 days. We placed a trade here and still waiting for it to work. TRQ came into resistance, sold off 18% today. Let's see where our profits are. $282, up 72%. We'll close that trade out. See this huge spike into resistance? TBI rallied 30% in 1 day. We got in here. It went back up against us for 7 days, 10%. We did not re-enter into this trade. You can see we're up almost $200, around 33% profit. Unlike T, down $90, 82% loss so far. You can see T in earnings day went up 7%. That was a big move for AT&T, so I placed the trade right here. Price kept going higher. I did not double down. Now here's an addendum to that T trade. So I talked about how T came up into this resistance and kept going higher, but I didn't do anything. And this is why I don't exit out of the trade. Because even after it went against me 7%, it fell right back off, giving me 50% profit. C's run up into resistance. We took the trade, up $50, 16%. PHM, huge run up into resistance, up $157, 35%. Since we're here, let's take a look at Overstock, 52%, $545. Overstock came up into resistance. We took the trade. Now you can see we're up 50%. I know it seems pretty boring, right? Up against resistance, take the trade, make money, get out of the trade. If it goes against you, double down, make more money. But that's really what trading is it needs to be consistently boring. If you want hype, go be a rapper. If you want money, do something consistently over and over and over again. Okay, now that we have the general system down, as price runs up into a channel resistance line or a range box resistance area, we're going to enter into the trade. Now, the next part is kind of based on what you want to do. This is open for interpretation. You can use candlestick patterns like the hanging man, bearish engulfing, any of these bearish type patterns. Or you can use a Heikin-Ashi. As price runs up, you see a big wick here, then use the underside of the candlestick as support. Once it breaks below that candlestick support level, enter into the trade. Another way is use an impulse study that changes the candlestick color. Kind of like here, you can see the big run up, the wick pushing down, candlestick changed color, enter into the trade. Candlestick changed color, enter into the trade. But right here, we see that we're at a resistance level. And if you go by that, you'll have to wait till the candlestick changes the color to enter into the trade. Another way is use a trend line. Draw a trend line as a support level. Wait for price to break that level. Next is sequence counter. What's a sequence counter? It counts the bars 1 through 9. Then it plots an arrow for you to enter into the trade. As you can see, it's not perfect, but sometimes it gives you a good idea of when the trade's going to reverse. All of these options are up to you on what you feel comfortable with and what you see. Are you more conservative or are you more aggressive? Now we're going to go to setting up the studies for your charts. On Thinkorswim, they have a little beaker, and we're going to look at the impulse, the sequence counter, volume profile, VSI, and implied volatility. So on the Thinkorswim, you have it right here. Beaker, edit studies. Drop down will come up, studies. The candlesticks are red and green. Now with double tapping on this impulse, it'll come up into your study setting over here. Push OK, and it will make them blue. These blue candlesticks just indicate that the price is at neutral. Red candlesticks down, then neutral near the bottom. Green candlesticks up, then neutral near the top. Red down, and neutral. It's not a perfect system, so if you don't like it, then don't use it. Cut out the noise in your trading. Now to sequence counter. Double click. Comes up over here, push OK. It'll come up like this, pretty faint with this yellow. So I come into here and change the yellow to gray or something of your choice. So in this example, you can see over here, it called the bottom. Right here, it called the top nicely. And right here, it called it prematurely because price kept going down. That happens. It did not call this top, but it did call this one and this one. This bottom, a little premature, but worked out. And today, we use that arrow to get into this trade. If you like the arrows, but want to remove the numbers, just go back in to the tabs that say array, then click on these three, uncheck, and you'll have no numbers. Now on to volume profile. It represents trading activity over a period of time at a specific price point. This is called the point of control. It gives you a price range of 70% of the trading activity that took place. So it looks like this. This is the point of control, and this is the range 70% of the trading came in on. Sometimes I use this indicator to test and see how far I am away from point of control. Double click, should be here, and push OK. Upstart came into resistance and is 16% away from point of control. HYRE came up into resistance, but is 80% away from point of control. Children's Place is 70% point of control. I like to take the trades with the biggest point of control. If I can only take 1 or 2 trades, don't you want the best opportunities to filter down some of this noise? Click on the studies, click on globals, change your point of control to darker, and then change the other colors to match your background. Then under plots, point of control, make it darker and thicker. On the other tabs, unclick. Then you only have this line right here, not giving you so much noise, but you can analyze before making a trade. Next is RSI or VSI. And let's be honest, as price runs up into this resistance level, RSI is probably going to be overbought. But if I have the same volume profile and one stock gives me a divergence like these two, I find that divergence are higher probability over just being overbought RSIs. The slow VSI or RSI are both great choices, but you'll have to change a couple things. Here on the 80-20, go 90-10. On the overbought, make it red. On the oversold, make it green. Kind of simple, but that tells me sell the news. For the most part, these line up pretty comparable. Divergence, 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 divergence. But they're a little different because this went overbought here and this one went a little bit later. This one came all the way to the top line and this one's showing a divergence. There's no perfect system. Whatever works best for you. You pick which one you like or don't use them. Next is implied volatility. You can see as price ran up last time, implied volatility did the same. Price ran up into this resistance on news, and so did implied volatility. Volatility is not always the same. You can see here, price ran up, but the volatility went lower. As you can see, this is highlighted green because we're under 0.25, which means we would buy puts to go down and expect the volatility to go up from here. Price went higher, so did volatility. Right at the resistance where we purchased it, volatility fell off, adding 53% to our value because we were selling options here. Big run up. We see the same thing in volatility. So we sold the calls and you can see volatility went down, giving us back that premium. This spike was obviously not as great, but we sold calls also, and we've almost realized our target. All right, now for actually setting up your charts to match if you want. If you don't, no big deal. On Thinkorswim, we'll click on the wheel. Then we're going to go through each one of these categories to set things up. Right here, chart settings. Here's the general setting. Here's the price axis. Sometimes I move this to 10 to give me a little bit more room at the top here. You can see it's real tight. Typically leave the bottom at 0. You can see it gives us more room to draw. I don't really care about the bottom because I'm not taking support trades here. This is about sell the news. Time axis. I like 360 days. I like 4 hours because it gives me a better look on my implied volatility. I like 500 bars expansion because it pushes everything to the left side of my screen. Appearance. I do Heikin-Ashi. Background white. Grid off. Equities, I don't use volume because I know there's a lot of volume because price action's so heavy. I want to have corporate activity so I can see dividends and earnings days. I don't typically show the extended hours, but you can if you want. Next is creating a watch list. I do 3 different ones. Sell the news, either search, watch, trigger. So as I'm filtering through different tickers, I'll put them into this category. Sell the news, buy or now. So I pick the best ones that I want to take a look at when I'm looking for an option to buy or sell. Then sell the news trades, or you can do expiration month. May, June, July, August, keeping them separate by their expiration dates. Drop down this arrow, get the personal tab, select watch list, personal tab, and set up your different categories. All right, now how do we find this awesome trade? When you're searching for gainers, you want to find stocks over $20. They have to be optionable. Make sure they did not sell the company. We don't want dividends at all possible. You're going to filter through about 10, and you're going to choose 1 or 2 to trade. Now that you have some guidelines, we'll search top percentage gainers, new highs, gap up, trade flash, maybe a website with pre-market analysis, or one of your favorite websites. On Thinkorswim, back to this drop down, lovers and losers, pre-market, post-market, downgrades, upgrades, top percentage gainers, net gainers. Another search you could do is click on scan, click here, load scan, public, sell the news, gap up. This might be a good search. New yearly highs, coming into resistance. This might be a good search. Upcoming earnings. This might be a good search. Market maker move stocks. This might be a good search. Woo, that was a lot. Shake it off. Break it down, start applying little by little, doing a little bit more research, experience with what I just talked about to start formulating for yourself that plan of action. Being able to see the stocks up against resistance, start drawing on all of your charts, lines, range boxes. Right now, it's about getting the knowledge and skills, not the money. The money will come. Now that you have a lot of information in your mind, it's good to make a checklist. I like using this for my morning search. So let's go through a couple categories. Date, ticker, is the stock over $20? And write in the price. Is it up against channel resistance? Is it up against range box resistance? Does it have a harmonic pattern or something in that resistance? Maybe an arrow or candlestick pattern, change of color in the ticker, or break a trend line? Is there a dividend within the next 30 days? Is there a VSI or RSI divergence? What about 5-year resistance? What is the percentage away from the volume profile? And how high is the implied volatility? The higher, the better. So if we use a website like Bazinga, pre-market movers, and scroll down looking for stocks over $20 with big percentage moves over 5%. We'll take these stocks, write down the ticker and the price on our checklist so we can see what their charts look like. Another thing we can do is on Thinkorswim, there's a plus sign. Click on that plus sign. This tab will come up, Trade Flash. It'll start showing you big movers like NVDA. We look at the chart, we see there's support, we bring that support up, and we're right there against it. But it only has a 3% up run. BKE had a 9% pre-market, it's not up against resistance, and it's only at 3% now. PANW had an up run of 6% pre-market support. Duplicate that, we can see we're right up against resistance. Past earnings, no dividends. RSI's been going down, along with making lower highs, proving that this is a downtrend up against resistance. And we see the implied volatility going lower now that we've passed earnings. Let's go to the public search, look up percent gainers. We have ZIM. $45, so it's over our $20. Nice long-term resistance. Past earnings, 75% away from the volume profile. Divergence, implied volatility selling off over the 0.5 mark. So let's put this into our triggers. Upstart, making a nice rally, 5% today, $145. Support, duplicate this line up. We're right in resistance. Volume profile is only 20% away, but it's a relatively new company, and so you see the move is not that big. Implied volatility is high at 1.5, so that means we would sell some calls here. I'm getting excited. Let's add it to our watch list. RBLX, up 8% today, coming into resistance. Implied volatility is relatively low, and we're only 7% away from the volume profile because it's a new company. Let's keep looking. All right, here we are. AVID, nice up run, came into resistance. This would be the leg 4, and we're coming into leg 5. And here you see a high on the RSI, and now you see a lower on the RSI, giving you the divergence. We're past earnings and no dividend. We are 75% away from the volume profile. Volatility is over 0.6. Let's add this to our triggers. All right, now let's look at ANVS. We love this. It went up 136%, came right into this long-term resistance, already selling off. High RSI, but no volatility because they don't have options. Here's ALBO. Take the support line, move it up for resistance. You can see we're not quite there yet, and the volume profile's above where we want. We want it underneath. All right, here's the last one, MTW. They're not up against resistance, nor on a downward channel. All right, we're dialing it in. So now we're going to go to our tickers tab, and we're going to pick 1 or 2 out of these. BNTX is making a double top right here, while the RSI is making a divergence, and the implied volatility is at 0.77. but it's not up 5%. So we got to take that off the table. So remove it out of your watch list. Same with IMAB. Looks good, but it's down 4%. We found it a little late. NVDA is showing a lot of promise, just getting high enough for our implied volatility for us to sell it off. It's at 3% up today, so we're going to watch this for a little bit longer. We like OAS because it's over $20 and up 5% today. It's got 3 range box duplications showing us resistance, and it's got diagonal resistance. It's 55% off the volume profile. It's making a divergence, and the implied volatility is over 0.5. PANW over $20, over 5%, up into resistance. RSI selling off. Implied volatility is low though, right at 0.3. I'm going to take this one off the table. Children's Place, showing a lot of promise, but it's only got 2% up today. So even though it shows this resistance and making a divergence on the RSI, implied volatility is above 0.5. We're going to take this off the table. All right, now to Upstart. It's above our $20 mark, and it's above the 5% mark, up against resistance with high implied volatility. We like this. After earnings, no dividends. All right, so let's review the last 3 on our checklist. And you can see that NVDA only had 2% increase in price today, but it had a lot of blank holes. OAS did better. It's 54% away from the volume profile, which is great, but the implied volatility is only 0.5, which is the minimum we want to have when we're selling. Now, Upstart. Well, they only have 2 slots missing. 1, 5-year resistance because it's fairly new. 2, a harmonic pattern, which that's just a bonus, not a reason not to get into the trade. Also, because it's new, we're only 22% away from the volume profile, which I'm okay with. But what I like is that we are 1.45 on the implied volatility index, so we are able to take a bear call spread here. UPST, vertical, calls. We're going to be clicking on the bid side because we're selling. We want to know the open interest and the volume on the strike price, and of course the implied volatility. You can see at the money, the implied volatility is a little bit less than what it was on the chart at 123, which is okay. There's a good amount of open interest. Now selling the 150 calls and simultaneously buying the 155s, we can see that the cost is $280. Our reward would be $220 with a break even of $152, which is incredible because price right now could go up from here and still make us money. And that's why I say there's a lot of management to this. It's not easy to become a millionaire. You have to work at it. The management we're going to do in the class is find the trades, search through them, filter out the bad ones, find the best one that fits our plan, and then find the best options to make us the most amount of money in the quickest amount of time. Sometimes it's quick, sometimes it's not quick, and sometimes we lose. See you soon.